give you information that will help you solve your client's problems or give them opportunities to make their lives better by saving them money. So, Jordan, you're from Academy Mortgage. So, Advantage. I knew that.
He changes every month. We're not sure ever. I call him and ask him where he's at now.
I thought you were about to say I call him something else the third of the day.
And then
not
the-
good.
and then the whole-
It's not what you think, and it's not good.
Jordan has an advantage. I apologize. Jordan, one of the things I wanted to talk about was the differences between a mortgage broker and a traditional lender. Can you speak to that?
Yeah. And first off, Joel, I might need you to check on this one. Audio coming through okay for everybody online?
Ryan, can you hear us?
I'm not sure how good the microphones are back there, so.
It's pretty good.
Ryan, can you hear the speakers? All right, he says yes.
Perfect, okay. So, yeah, there are a few different types, and so I kind of break it down in about 3 or 4 different categories. So the first one that I look at is a mortgage bank. And, well, just a traditional bank, that's gonna be your Wells Fargo, your Chase, your Bank of America. And they're basically defined because they're lending their own money. And typically they're gonna be holding their own servicing. So that's a bank.
Do credit unions fall in that same category?
They can, but not always. Credit unions can kind of be. The next one is going to be a mortgage bank. And so mortgage banks can be different from a traditional bank because they don't have their own credit cards, they don't have their car loans, they don't have their own savings accounts, they just do mortgages, but they do from their own funds as well. Usually it's going to be some kind of a credit line they fund it through.
And what's an example of that?
Yeah, so most mortgage companies you think of, Academy Mortgage, Guild, Pacific Residential, Movement Mortgage, typically all the main mortgage companies you think of fall under that mortgage category. Some people call them retail lenders, some people call them correspondent lenders, all those categories are the same thing. And then mortgage brokers, they don't have, it's similar to a mortgage bank in that there's no deposit accounts, there's no other individual car loan or something like that. But rather than having their own funding source, they'll go shop to other wholesale lenders and kind of pick and choose which companies they go through. So there are pros and cons to all of them. The pros to traditional banks are typically going to be on the higher net worth clientele side. So if anyone's familiar with private banking, so Wells Fargo, Bank of America, Chase, KeyBank, all of these companies, they have their regular products, but they also have a private client or private banking side. And that's where they'll do things that aren't typically accessible to the public. If you have higher net worth, if you have higher amounts of lending that you're getting, then they'll say, oh, well, if you're in this category, rather than our typical 7.5% rates, we'll give you a 3% rate on a jumbo loan if you have $1 million of assets on deposit with us. Because they know they're making the money in other areas, they don't have to make it just from the mortgage side. And so for some of those category ones, honestly, banks can have some really competitive products, especially Bank of America and Chase. And they get really competitive for those jumbo loan scenarios. For everything else, not so much. So that's kind of my one main pro for the banking sector. Mortgage bankers, they're going to do much better than the traditional banks as far as service goes. So with a traditional mortgage bank, they are going to be much more service oriented. They're typically in-house for processing and underwriting. They're going to have a local presence here. It's not going to move around to as many people behind the scenes. Whereas a traditional mortgage or a traditional bank, I mean, you might be talking to 4, 5, 6, 7 different people, all getting paid very, very little. So there's not a ton of incentive there. They can get their money in it. So mortgage bank, this is where most mortgage companies come in. They have a bit more skin in the game. They're typically going to be loan officers get on commission, making higher rates of income. And so there's actually incentive to higher levels of education.
Yeah.
Typically more education there. Mortgage brokers.
Oh, perfect.
To be
If they're both going.
on interest rates for the majority of products and have some more offerings, because rather than just being capped into one individual bank, and what that bank wants to offer you competitive on. A mortgage broker can be able to go to one bank for FHA loans, one bank for conventional loans, one bank for HELOCs, one bank for jumbo. And I'd say the range of quality for mortgage brokers can become high, because you don't know how experienced they are with that lender they're going through. You know, I have several really, probably over 50 different lenders that I can go through as a mortgage broker. But if I've never used one of those companies before and I'm using it for my first time, it's a very different experience than a company that I use very, very frequently. So just because somebody's a mortgage broker doesn't mean they're good. Just because somebody's a bank doesn't mean they're bad. A lot of it comes down to the individual and how familiar they are with their product lineup. Just like for me in particular, a lot of people here know or have experience with this. If somebody comes to me for a product that I offer, but I don't have enough experience with, I typically lean towards referring that to somebody else who does have a lot more experience with that. So HELOCs are a great example. There's a credit union that I really like working with. They did my personal HELOC. They do a phenomenal job. They've got the best interest rates, the highest amount of loan to value.
Who's that, Jordan?
That's credit union. And Eric Taylor over there, a great guy. I mean, he can get them done in like 2 or 3 weeks in his cases.
What's his name?
Eric Taylor.
Will he loan on, and this may be a question for him, but there are some credit unions that will do HELOCs on a property that's listed for sale.
I don't know the rules on that one, and I tend to lean toward probably not.
Well, it changes to a bridge loan at that point, I think, basically, right?
Exactly, yep. That's kind of a brief overview. I mean, I could probably go into like 3 hours of the nuance differences, but that's not what we did talking. That's the general.
So the majority of mortgages, did you say, are they 30-year fixed
Oh, yeah.
mortgages? Okay. What are the basic types of mortgage programs that most consumers are using?
Yeah. It's going to be 4 main types. So conventional, FHA, VA, and USDA. And just to give you an idea on the percentages, you got about, rough numbers on this, 50% of people getting conventional loans. You get about 24.5%, 24% getting VA and FHA. They're kind of about tied right now. And then somewhere between 0.5% and 1% getting USDA loans. And those are the 4 most common. So everything else is even smaller percentages. So you might hear stuff like non-QM, or jumbo, or HELOC, or private hard money loans. Those are certainly out there, but they're very small percentages. By and large, the 3 big ones are conventional, VA, and FHA.
And when you say VA, you're talking federal, correct?
Correct. Yeah, good point. State VA is still an option, but even less than 0.5%. I agree.
What are some of the differences between the main mortgage programs? So not everybody can get a USDA loan. Not everybody, qualifies for, has the down payment for FHA. What are the main differences?
Yeah. The way I like to look at it is I start with the most beneficial loan programs and look at what's going to disqualify somebody from this program. And the order I kind of go in is VA first, USDA second, conventional third, FHA fourth. Not to say that anything is better or worse than another one, but it's typically that's going to be the most advantageous for people. But there are other information comes up. So when I'm talking to clients, the first one I always ask is, have you served in the military before? Maybe you're eligible for VA loan. Because the great part about a VA loan is, and we're getting talking about federal VA, doesn't require down payment in most all circumstances. Very low interest rates in comparison to other types of loan programs. Very wide acceptance. So they typically keep you pre-approved for more than most any other type of loan. You can do some really cool things we can touch on later with the seller credit, including paying off personal debts with seller credit, which you can't do with other loan programs. So really cool program. And if somebody has the ability to use a VA loan, there's very few circumstances that they wouldn't want to do that. So that's the first one I've done. If they're not a veteran, next one I go to is USDA. USDA is a very narrow box that people can fit into because you can make too much money to qualify. If you make less than that amount, then they also have the highest restrictions as far as that income ratio. So it's not uncommon to get approved for say 200,000 on a USDA loan, where FHA might approve you for 400,000. That's a number I run into quite often. And the other thing is it's location specific. And so you can't use it in Albany, Corvallis, in Salem, Eugene, Medford, kind of the bigger cities along I-5. So outlying areas are going to be eligible.
And is that census numbers that define those areas? What rural?
Yeah, so the easiest way to go is you can just search online for USDA eligibility. And the website is a government website, so it's a bunch of acronyms in the URL. So you can search USDA eligibility. I love that first one is not an ad. It'll basically bring up a Google type map where you can search by address or by area, and it'll just show you exactly where those outlines are. And anybody was publicly accessible there.
How often does that change?
It hasn't changed in a while. They're talking about changing it this year, but it hasn't changed in a few years. So there's not necessarily a set increment. They were talking about changing it last year, but it didn't. So every once in a little while.
Yeah, but I know I live in Columbia County and in St. Helens, and it seems like there's always talk of St. Helens is going to be in that USDA. But it always seems to be, so, right.
Yeah, so at least for now, if and when it changes, I'll probably post it by week. I'd say if you can fit into all those categories where they're approved for enough, they're looking in the right areas, they don't make too much money, then USDA can be great.
It's always the question, though, is it being approved for enough, right? I've never closed the USDA because they don't ever get approved for enough. So is there a ratio you could go by FHA versus USDA 2 to 1 or what? It seems like they're half price when they get a.
So the main kicker on USDA is when you're looking at this ratios, there's a front and a back ratio. The front is what your housing payment to your income. The back is what your total debt to your income. So with USDA, with some exceptions, the front ratio is 29%. The back ratio is about 43, 41, 43. So what that means is if you don't have any other debt, your maximum debt to income is 29%. Conventional is 50. And FHA front ratio is about 47.
So so if you're making 100 grand, if you're making 100 grand, you can only get 29,000.
More or less, yeah.
Yeah.
And if you're making 100 grand, you're right on the cusp of not qualifying.
Making too much then, right?
Exactly.
Yeah.
It's interesting to hear you say that you don't think you've ever closed a
I've never
USDA.
closed one.
Done hundreds of them. And I don't know. if it's
I've had
because
clients who are
home
qualified, I
prices-
just can never find them a house at the price in the USDA. Yeah,
That's what I'm thinking, is home prices went up.
Yeah.
Lower, so-
That could be.
Yeah.
Find a house for living.
And it used to be a much more expensive program, much more inclusive. They have tightened in recent years because the idea was after 2008, a lot of people needed help in programs like FHA, USDA, because conventional really tightened up. So the government programs kind of picked up the slack. Now it's turning the other way. So a lot of things have been tightening up, and now FHA is the one that's loosening for a lot.
Right. And when you say USDA, there's a difference between USDA loans and USDA direct, correct?
Correct. Yes.
So we're not talking about USDA direct.
No.
It's totally different.
Exactly. USDA directs are very, very, very small percentage. They go, as the name says, directly to the USDA. So you're never going to work for a different lender for those. It's a subsidized program, so you do have to be in a loan category qualified, and they subsidize the loan. So it's kind of like Section 8 housing, but for a mortgage loan.
Yeah.
Okay. Very rare.
So then let's go to FHA.
You guys speak up a little bit. They're having a hard time hearing you.
We have you guys do this stuff.
Well, they were fine until I started talking. I guess I blew out the speakers or something.
So then, so USDA, and then FHA conventional. The biggest thing I used to differentiate where somebody falls there is gonna be credit score. A lot of information's been out lately about the loan level pricing adjustments. And, you don't have a good grasp on that, weekly market updates, I have a explainer video to understand it, talk to clients, and but there's just debate is that conventional loans are starting to price out people with lower credit scores. It used to be that if your credit score is around a 680, maybe 700, or FHA is really good, well, but above that, conventional is going to get you the best options. Now, I'm seeing a lot of clients with a 740 credit score who are going FHA because FHA lowered their mortgage insurance premiums, conventional raised up some of their interest rates on higher credit scores. So,
Which seems counterintuitive.
yeah. There's a number of reasons for it, I believe. It doesn't, there's not a whole lot we can really do about it somewhat. Just knowing that we're probably going to see a lot more FHA loans now than we did before, because conventional is getting a lot tighter and FHA is getting a lot more attractive for clients, even with higher credit scores. So that could even just be a mental shift where FHA for a long time was thought of as, oh, this is where the first time home buyers with bad credit, and, bad income and low down payments go. Now, you could be a second home buyer, you have a conventional loan on your first house, wanting to buy another property, you can use an FHA loan, buy it with 3.5% down, you can do 10% down. So you might have a 720 or 740 credit score, but FHA still might be more attractive from the interest rates.
Does mortgage insurance stay on an FHA loan for the life of the mortgage?
Yeah.
And they can't. What's the word I'm looking for? Yeah.
So you have to refi it,
You
basically,
have to
to get it.
refi into a different loan program.
Exactly.
Okay.
Yeah. So that's one where down the road, if conventional might make sense to refinance on it, you have to refinance to a conventional loan to get rid of it. Because even USDA still has mortgage insurance, which is a very small percentage. But it still like, it stays on for the life of the loan as well. So
FHA appraisal, question about what. Is it only FHA loans or is it any government backed loan that the appraisal stays, a low appraisal stays on the property? For a subsequent FHA buyer
FHA and VA.
and VA as well?
Yeah, FHA and VA. So those are, just to reiterate your point, where if an appraisal comes in for one buyer, next buyer wants to come and use the same type of loan, then FHA and VA appraisals will stay with that property typically for about 6 months, depending on the time frame. But
Do they cross over?
that's what I touched on, yeah. So a VA appraisal doesn't affect an FHA buyer, and an FHA appraisal doesn't affect the VA buyer.
All right.
And then conventional, if the conventional appraisal comes in low, you can order 5 different conventional appraisals, get 5 different valuations on it, none of them stay with the property. And I've done that even with the same buyer before in some situations. So, and then,
That sounds expected.
Yeah, no kidding.
I didn't order 5, I ordered 2. First one that was low, and next one that came in where we needed it. But yeah, it could get pricey if you want to take that gamble. And so conventional, typically where I find conventional makes the most sense is a strong down payment, really high credit scores. Because the more you have a down payment, typically about 25% or more, it starts to really negate some of those pricing adjustments. And so if you've got a 25% down payment, even if your credit score is really low, the down payment starts to offset that from an interest rate standpoint. So those are the times when I'll kind of compare options to people. Like, now we're doing 10% down. I'll usually show them FHA and conventional. And then the last piece to look at is how much are they wanting to get approved for? Because if you run into FHA loan limits, depending on the county, the base loan limit is about $470,000. If someone's looking at an $800,000 home, well, they're probably not going to go FHA unless they've got $300,000 down. So conventional would you rather give them a higher approval amount, because conventional loan limits are about $740,000. So all of those factors I kind of take into account to determine which is going to be the best route for them. But I'll have to go to most clients that are involved in either VA for veteran or FHA for conventional.
Talk a little bit, if you would, about loan programs. If there are any, for land.
Yes, loan programs for land. So there's not, with the four main loan types, conventional, FHA, VA, and USDA, those are government overarching programs. Everybody's got them. The guidelines are dictated from the national level on it. And all the lenders are basically just writing loans to those standards. With land, there isn't an overarching government-backed program for it. So anybody who does land is doing it out of their own money. So that's where banks will be coming into play, credit unions will be coming into play, private money lenders come into play. Because if they would decide, hey, we want to go ahead and do loans for land, they can do those, but all of the interest rates, all of the terms, the down payment requirements, if it's a 30-year loan, if it's a 15-year loan, if it's a prepayment penalty, that's all going to be determined case by case.
Is that true with jumbo loans as well?
Yeah. Exactly. So that's where you'll see a much bigger spread on interest rates and terms and who gets approved on jumbo loans and land loans. So in those situations, it's really helpful to have multiple people who can do those loans.
Trying to nothing to see.
They're closing or something.
When you've got multiple people who can do them, become familiar with their guidelines where you might have 3 or 4 different lenders who can do jumbo loans, let's say, or commercial loans or land loans, because not everybody's going to fit into one box. Whereas, I mean, a conventional or FHA loan, you can all individually look up exactly what the guidelines are for those. They're not the secret, they're not hidden. Did that answer your question?
Yeah. So talk about the differences in loan programs, types of mortgage programs, mortgage brokers versus lenders versus others in the game. What are some ways that agents can present info to clients that are nervous about rates? How can they present info to client anxiety
Yes.
and present options to them?
Because that's really the question. I mean, when I look at what I do, I think what we all do is we help our clients understand their options and set realistic expectations. Right? That's it. We don't for them. Hopefully, we're not. And getting them to a point and they can be very clear on the site. Yes, I do want to move forward. Here's what it's going to look like. Because the other things I look at are somebody can qualify and somebody can afford 2 very different things. I might tell somebody that they can qualify for a $400,000 home with or whatever XYZ per month payment. But if they feel comfortable affording a payment on a $325,000 home, it doesn't matter what they qualify for. So to answer your question, how do we present the information in a way to help kind of calm fears? I rarely talk about interest rates. I talk about monthly payments because interest rates tend to have this emotion attached to them. You know, when people talk about a 2% interest rate, I mean, even when I say that, there's this little thing in the back of my mind. It's like, oh, 2% interest rates. You know, there's a positive emotion. People think 6%, 7% interest rates. Ooh, exactly. It kind of spooks people a little bit. Yeah, I actually just thought about dressing up as a 7% interest rate for Halloween. Yeah. I don't know how many people do that, but I'm glad you all gave me a shot. So thank you. Good job. Appreciate it. So rather than talking about interest rates, I really talk through where do you want your payment to be? Where do you want your price range to be? And once I have those 2 things, then I can work backwards on, okay, with your down payment, with your loan type, with your credit score, here's the price range that's going to give you the payment you want. And here's the payment at the price range you want. And sometimes there's a gap there. And somebody says they want a $2,000 loan payment, but they want an $800,000 house. My question is, where are you coming up with the $550,000 for down payment? Because that's what it's going to take. But none of that has any interest rate attached to it. I'm seeing the interest rate, and I'm using that on my side to calculate the payments, but there's no emotion attached to the payment. Your payment's $3,500, your payment's $4,800, your payment's $2,000 a month. It's just a number, and it takes that emotion out of it. So that's one of the best things I can recommend is don't talk about rates, talk about payments and the range that those payments are getting into. This payment equals this price equals this payment. And then from there, it's okay, well, if you want to change that, here are the tools we can use to do that. We can buy down your interest rate, pay $4,000 now, save $200 a month. Right, well, what's the rate difference? We can get into that, but it's secondary. It just happens to be that you're buying down, say, 0.5% in interest rate. But it's more, what's the difference in my cash out of pocket? What's the difference in my monthly payment? Because people don't budget based on interest rates. People budget based on monthly payments.
Cash flow.
Exactly. So then, I mean, you still might have somebody look at it and go, oh, wow. You know, I had a client today, they said they wanted to pay $1,900 a month. But they wanted a $400,000 price, and they had about $50,000 for down payment. So after that situation, told them like, well, you're going to be about $2,600, $2,700 a month for a new payment. And I'm like, okay. Well, it's higher than you can do, but you know, no motion. And we're like, all right, well, appreciate it. Thanks for letting me know. Great.
At what point do you step in and say, here's some other tools you're willing,
Yeah.
that we can use to lower that monthly payment?
You're still on the first conversation, because especially on the theme of different hacks, you know, mortgage hacks that we can use. One of my favorite tools right now, especially with high inventory, you've got a lot of sellers with low interest rates that are hesitant to move. You know, they're worried that, oh, I'm gonna double my rate by 3, and I'm gonna go to a 6 or 6.5 or 7. I can't do that. That's a stupid financial. Not always. One of the things that I really like right now is a debt consolidation purchase. So a lot of, I mean, when rates were low, a lot of people were consolidating debt by refinancing and throwing their car loans, their credit cards, their RV loans, you know, all of these things into their mortgage, and they lower their monthly payments. They happen to be doing that with a lower monthly interest rate. Right. So now, if you've got sellers, especially who've taken out home equity lines of credit, interest rates might be moving up on those. A lot of people didn't recognize when they got them the last year or two that those are typically adjustable rate loans based on the federal funds rate. Right? So we might have been at 2 or 3% before. We got people that are going to start seeing 5, 6, 7, 8% on those. So you've got that. Interest rates on credit cards are also attached to the federal funds rate. Car loans, all these short-term debts. So if you've got somebody with $50,000 of debts between car loans and credit cards, student loans, pretty soon look like they might actually start becoming payments due. And we'll see, it's about 2 months now. We'll see if they extend it again. But it looks like once all those payments start coming, it doesn't matter if they have $200,000 of equity in the house, they still have to pay on these other debts. So right now, what I've been looking at is to say, okay, if you sell your home, take 200 grand, don't put all of that into a new mortgage. Put 150 into a mortgage, take 50,000, pay off your debts, and get rid of $1,000 a month of debt payments. But now, if your mortgage is $1,000 higher, you pay the same money out of pocket every month. And so that debt consolidation purchase has helped a lot of people be able to go into a new home, better location, better property for them, and have the exact same amount of money out of pocket or very, very close to it. So that's when we're all asking, okay, great, where's your equity? How much are you going to sell it for? How much do you owe? But also, what do your other debts look like? Do you have any car loans? Do you have any credit cards? Do you have any student loans? I've got a client right now who's got an RV loan for about $80,000. And with car loans, you know, if it's a 2% interest rate car loan, yes, it might make sense to include it, you know, to pay that off. But it's a really attractive interest rate. For this person, their RV loan is at 6.7%. Their mortgage is going to be 6.8. So it was easy to move it over, lower the payments on it, and tell them, yeah, you will pay more interest over 30 years if you make the minimums, but free of your cash flow, you always have the option of paying more on it, but it gives you that breathing room, right? And those are the tools I really like to use right now. How can we look strategically about lowering monthly payments, making it more comfortable forward for you with the exact same amount of money out of pocket, but lowering your cash flow. So that's a really good one right now.
What are some others?
Other tools are, so buy downs. You've got permanent rate buy downs and temporary buy downs that are very different. The only similarity they have is that you're paying money now to lower your monthly payments for your interest rate and stuff like that. Beyond that, you think about them in very different ways. So the tried and true is going to be the permanent rate buy down. That's I pay X, Y, Z now, I get a lower interest rate for as long as I have the loan. I really like that one. Because it doesn't matter if it's paid for by the buyers, if it's paid for by the sellers, that all of that's fine. It's basically just a math equation on the time frame. If I pay $4,000 now and I save $2,000 a year, it's gonna take me 2 years to break even. Do I think I'm gonna have this loan for 2 years or more? Because historically, it's taken about 5 years to break even on those, but lenders right now are pricing them very aggressively because lenders believe that rates will be lowered in the very short term. So I'd say take advantage of it. Right now, $4,000 towards your down payment is gonna save you about $30 a month. $4,000 towards your interest rate buy down might save you $200. So it's a way much bigger bang for your buck to take the same amount of money out of pocket and put it towards the buy down than to put it towards your down payment. Plus, if you're in the home for 3 years, you make more money than you've got. Temporary buy downs or 2-1 buy downs, 1-3-2-1, any buy down that has a number ahead of it essentially is a very different way of thinking about it. Those are going to be ways of using extra seller credit. That's it. And the way they work is that if I pay $8,000 for a temporary buy down, the benefit I get is exactly $8,000. No more, no less. It'd be the same as me saying, hey, Angela, there's $8,000. Can you give it back to me slowly over the next 2 years, please? It's the exact same money. So it doesn't make sense for the buyers to pay it because they're just giving away their money and getting it back slowly. So the way to use it is rather than negotiating lower on the price of a home, if you've already got enough seller credits to pay for your buyer's closing costs and you can negotiate more, that's when you can use more seller credit and apply it towards a rate buy down.
Is there anything that you need to see, that you would need to see in paperwork specifically on like an addendum for that? You got through the repair addendum and stuff like that. You already took some closing costs. Now we're gonna do XYZ, just.
Yeah. So, and for anybody who didn't hear is asking, is there anything specific you need to see in the paperwork when doing a temporary rate item? If you do the wording in your seller credit to say, seller to pay XYZ towards buyer's closing costs, prepaid, and rate buy down, that's pretty much covered.
Yeah.
I have seen a couple of times where that last part wasn't there and rate buy down, and an underwriter would say, hey, we need an addendum saying they're okay with the rate buy down. But it wouldn't be a bad idea for Angela to confirm, to just have that be your standard language for all seller credits.
That feels like it keeps having, because I feel like the more times you have to go back and forth, because that relationship could have started out great.
Right.
And it's already rough,
The more
getting another ask out of them to do that, so probably like,
Yeah.
do it up front. And then we're just looking at, hey,
Then it's up to the lender how it's gonna, where that.
It gets-
Which hole that money's going.
yeah, we push that back in there, and then you get to dialogue with buyers on, hey, okay, so we got this, how do we apply this? Do we, maybe your closing costs are a little bit more, but we're doing this bigger buy down.
Right.
Yeah.
Exactly. And you can do a temporary and a permanent rate buy down together. So if you do the way the temporary works, let's say you're doing a 2-1 buy down. If your normal interest rate is 6% for round numbers, year 1 is going to be 4%, then year 2 is 5%, year 3 is 6%. But if you do a permanent buy down from 6 to let's say 5.5, well now then you start out at 3.5, 4.5, 5.5. So you can do them in conjunction. The limiting factor is how much seller credit you're getting, and part of that goes into how much seller credit can you ask for with the loan program, right?
Which was gonna be my next question.
Yep. So in the mortgage tax playbook, it does actually have the accurate guide for conventional. Because conventional, there's a matrix to figure out how much you can ask for. It depends on, is the person buying it as a primary residence, second home, or an investment property? And how much money are they putting down? All of that's going to change it. So it's as little as 2% for an investment property, regardless of down payment. 2% of the purchase price is the maximum you can ask for in seller credit on a conventional investment property purchase. If you're going to be doing a 25% down payment or more on conventional and its owner occupied, you can ask for up to 9% in seller credit. And then the standard, most of the time, is owner occupied with less than 10% down is 3%. So if you want to double check on that one, you can always ask me, hey, can you just confirm on this one how much we can ask for? But always do the check with the lender before you're asking for a bunch of seller credit, just, hey, we're about to ask for this much, can you use all of it?
And what's the maximum fees on VA?
On VA is 4%, and USDA and FHA is 6%.
So like when somebody wants to do seller credit and the. Let's say they're gonna get they want to get the 6%. That the seller. That word, anyway, they agrees to sell the house. At that, like 6% higher price than what, and then they could use that money. For a rate buy down.
So is the question essentially,
It has to appraise.
can we increase? the
Yeah,
price?
and it ends up appraising for that elevated price. I kind of had something like that happen where the.
Yeah.
The seller wanted to get this, the 6% and. When they use that seller money, so the seller agreed, but they were gonna purchase it at a higher price, which it appraised for.
You know, it's funny, especially if anybody checks out my podcast, I recently had an appraiser on to talk about some of it, but it's funny how often the value of a home comes in at exactly what the contract says it's worth.
Yeah.
So in that situation, if you are doing a higher sales price to offset the seller credit in a case like that, because I see that a lot, make sure you do that before the appraisal is done. Because it's not uncommon to have a $400,000 sales price. Appraiser gets a copy of that contract, is gonna go out and do the report, and then just before the report's done, we say, oh, actually, we're gonna do a 406 price, and seller's paying $6,000 for closing costs. But if the appraiser didn't have that, value comes in at 400. Would the value come in at 406?
I bet it would.
Probably, because in the podcast, when I was talking to an appraiser about it, is realistically, the only reason they have to give a number is because that's the way lending is set up. They need to have a value, but more realistically, it would be a range to say this home should sell between 390 and 410 in about 60 days. That would be a more accurate representation. But they can't do that because of the way that the lending guidelines are set up. So when they have to come in with a number, most appraisers try and work backwards to justify our sales price. And if that sales price changes, it's best to have them know about it before they give us the report evaluation, because after the evaluation is out, now they're under more scrutiny if they change that number. It's kind of like if we file their tax returns and then amend them, IRS is going to have a higher risk of auditing that because we filed something that we changed it. So it's definitely doable. I see that a lot. Just make sure you change it before the appraisal is done.
I have properties where we got multiple offers. We were listed at 425. We got offers at 450. What do you know? The appraiser came back at 425, which was the list price. Is that just a lazy appraiser, or
Could be. Could be.
because I mean it could have easily gone to 425.
Is, you know, whether they know about multiple offers or not, whether they take that into account, whether it's a lazy appraiser, whether they just don't have information. You know, I know that there was an agent I talked to who did a lot of new construction, and it was higher quality homes. They were custom homes. So they asked the agent, the appraiser called them and says, hey, help me justify this here, because your homes are selling for, call it, 450. Similar floor plans, similar size homes are selling over here brand new for 400. Why is this worth 50,000 more? Great question. And the agent was able to walk through with them and say, like, okay, well, tell me this. What's the difference between a Civic and a Ferrari? They're both vehicles. They both have a hood. They both have a trunk. They both have four wheels. They both have a steering wheel. Like, they get you from A to B. What's the difference? Why is one exponentially more expensive than the other? And so we walk them through the house to see, okay, here's the granite countertops versus whatever. Here's the, you know, the cabinets that are custom versus builder grade. You know, you've got this much money here, this much money here. And at the end of it, the appraiser is kind of going like, gotcha, okay, that's what I need. So part of it is not necessarily that appraisers are doing a bad job, it's they don't know what they don't know. when you get appraisers that aren't willing to be humble about that and aren't willing to ask for more information or aren't willing to be collaborative with you, that's when you can run into issues. You just don't know how they came to that number. But the good appraisers typically are willing to admit that they don't know everything and ask for help to people to find out what they don't know.
And I think a lot of agents are really unclear on when they can talk to the appraiser. You know. When can I show them my comps? When can I, ask questions? What are some guidelines? For agents in that?
Yeah, it's tricky because it's a gray area in that agents and lenders are not supposed to have any undue influence on the appraiser's opinion of value. But what does that mean?
You can't give them cookies.
Is that influencing the value?
Well, it could.
Depends on how much he likes cookies.
Yeah.
Right? Depends on how much money he lost in the poker game with you last Friday night.
Yeah, exactly.
Yeah,
And I know agents who regularly, speaking of their cookie company, they regularly will meet the appraiser at the house with a plate of freshly baked cookies. Are they trying to unduly influence the value?
I usually will meet them or email them. These are the comps I use to price the home.
And you do that
And that's what,
before or after the appraisal's been.
oh, I do it because I know who the appraiser is, because I'm the seller's agent. So he calls me for the appointment. I say, hey, what's your email? Can I see some comps I use to sell the home? And then I say to him. Absolutely.
and then a good narrative, I mean, you got multiple offers and stuff like that, was that narrative, I've seen a.
Yeah, we have multiple offers. Do you want copies? Yeah, I always have that too.
Not ask for copies, but take the multiple offer narrative at face value, or say, can you get me those? So, I've had a couple, I have yet to dialogue with one on the listing side.
Look at that.
Wow.
And you catch the water, just
Wow.
like dance.
I've yet to have any of them be just Snoopy or anything like that, like I've got this, I don't need any of your stuff, like most of them just been like, hey, whatever you got, send it to me, that's, if anything, it's just another set of eyes looking at stuff, so.
I think that's where most appraisers are gonna be at, if you approach it right. And I know that you are approaching from that standpoint. If you are sending something to the appraiser to go, hey, here are the comps that we use, make sure you use these to come to the same value or something along those lines. It's very clear that you're insinuating or very direct in saying, this is the value that we need, make sure you use the information I'm giving you. That's what I would be very worried about it. But if you come from a respectful standpoint and say, here's where like you said, here's the information I use to come to my listing price. And where would it be helpful to give you the comps that I used? Would it be helpful if I sent you copies of the multiple offers we got on this property? You're putting the ball in their court. You have to say, I have information. Would it be helpful if you had that same information? And I think by and large, most people are going to be fine with that. The appraiser that I interviewed on my podcast, he even said he likes it when somebody else is there at the property with him for a couple of reasons. One, if he has questions, have there been any updates to the home? Were there multiple offers? Whatever the case may be, it's easier for him just to be there and ask those questions in person than try and find somebody after the fact, either call them or try and email them, whether they get back or not. I know we've talked about how that's not always strong suit sometimes. So that's one reason. Another one is just for personal protection. If he's in a home alone by himself, there's liability, as with everybody. So for him, he sees it as helps for collaboration, and it helps just for an extra set of eyes to protect. Hey, I'm here, somebody else, more than one person in the property right now. But I just say, ask, would you prefer that somebody else be there at the property? Would you like me to give you any information, either email or physical copy with a comp? I think if you ask those questions, you're pretty much always going to be safe with it. If you're asking, hey, anything I can do to make sure that you come in at a value, probably leave that question benched.
And better to ask those questions before he's done his inspection and the look at the property.
Yes.
Instead of coming in later and saying, you're wrong because they account for this. Exactly.
And if I can touch on appraisal reconsiderations. A really great piece of advice when you're looking at coming up with a value, especially providing comps, or let's say appraisal came in low, you can provide comps to try and reconsider the value of the appraisal. Most times, people will start with the price and say, oh, here are other properties that have sold at similar or higher prices. If they're not comparable, if they're smaller property, larger properties, if they're higher quality, whatever the case may be, the appraiser might look at those and go, I might have been high on my value, I might be lower it. Instead, a better way to go is to look at what properties are very the closest possible in size and age and quality, and then come to the value there. Because that's the way that the appraiser is going to do it. They're going to try and find homes as similar as possible to it, and then work backwards on making the adjustments.
Well, they use a bracketing, kind of component.
Right.
So they're finding low and higher value and bracketing
Exactly.
their value assessment.
If this lot is bigger than this lot, I'm gonna make an adjustment for the lot size differences. If this home is, has a garage and this one just has a breezeway, I'm gonna make an adjustment for that. And they'll try and come up with a similar and adjusted price. Ideal world, every single home ever built would be identical. And then you don't have to worry about that, but that's not the case.
When you always have those homes, you know, it can be two exact homes, but one of them has this amazing view of the river and the mountains and faces east to watch the sunrise, and this one looks at a backyard full of concrete. Right, so, you know, how do you adjust for that? And how do you account for that? And that's one of the tricks with listing a property. It's finding.
Some of the appraisers, so like every time I get an email, like, hey, anything about that property, I always try to make sure, like, if it's a previous sold listing, that I'm being as cooperative and helpful with as much information as possible, because I mean, if I've got that reputation for being helpful to an appraiser, they're reaching out, if I just ignore them, then, you know, it does nothing to nurture the relationship. The flip side of that can be is like, you end up with an oddball property, and trying to come up with a valuation on it. And I mean, you're looking for something and, you know, having a couple of appraisers that you're like, okay, what, you know.
Yeah.
I'm flying a little bit blind because this is really quirky. And I don't want to just throw a random number at any suggestions that we'd say, or how much does a killer view add? Is that 15%? 20%? You know, 10?
This is kind of where I went with it.
Yeah,
Would you, do you have any other insight that might change my
exactly.
approach?
Yeah.
Yeah, I think, and that goes back to communication, just having that relationship and establishing that good communication with that appraiser. Can help you in later transactions.
They'll pick up the phone and,
Right.
you know, it's like, oh, yeah, you know, that I would, if you want to figure out what highest and best use on that property right there is, these are the things that I would be looking for. If I was asked to do an appraisal on it.
Yeah, perfect. We got a couple of appraisers that I can call and ask those questions to, and it's such an incredibly valuable source. It almost feels like I'm cheating every time I call an appraiser and ask questions on it.
You want to close your office door and talk in secret.
I know, right?
Yeah.
But at the end of the day, the system has created this veil that people are afraid to cross, and at the end of the day, it used to be very collaborative, and it still can be, it just has to look a little different. And I think appraisers, just like any of us, they are in a situation where they want to have relationships, they want to have collaboration on it. The system kind of shafted them the way it's set up with the appraisal management companies. It doesn't mean that they're bad people. It's the same reason why lawsuits are always hard, is because you've got attorneys between you and the other person. It's difficult to have a collaborative conversation. There's a reason for that to happen, but it doesn't mean that the appraiser can't have a conversation, doesn't mean you can't have a relationship with the appraiser.
So we touched on mortgage cap, what I'll call mortgage cap number one, which is buy downs. What are some other options for buyers, no, in this market.
So other options. You can look at a few different things, looking through the mortgage hack playbook. On adjustable rate mortgages. They're good in theory. But in practicality, aren't necessarily as good as they should. So adjustable rate mortgages, typically the hybrid arms are where you can have, say, a 7-1 arm, which is it's locked for 7 years, and then after that, it adjusts once a year for the remaining 30 years longer. And traditionally, those have had lower starting interest rates because you're taking on the risk that it can go up later down the road. So the idea being, oh, well, if it's locked in for 7 years, and I think rates are going to go down, I'll take a lower interest rate now, and then refinance to a lower rate, or pay it off or sell or something like that. Good in theory, but the problem now is that since the lenders, we touch on this in the buy down, because they're thinking that the institution as a whole, the rates are going to be lower soon. Almost all lenders are pricing adjustable rate mortgages higher than conventional loans. Because there's really no benefit to the lender right now to offer a lower rate if they think people are going to refinance out of it. Because they're basically just saying, well, I'll just give you a lower rate for free. And they don't really want to do that. And it also increases the risk if the person stays in that loan and rates go up, that they're going to refinance out of it later, costing them more money. Or that they're going to default if the rates adjust higher. So there's really no incentive for a lot of lenders to offer competitive adjustable rate loans. There are still a couple of lenders that will, especially like in jumbo loan scenarios, where for them, it's like, well, if we're doing a 20% down payment, they've got an 800 credit score, they got $1 million in the bank on deposit with us, sure, we'll offer you an adjustable rate loan and even more competitive. And this is one where I see credit unions, typically going to be more competitive on ours, or big banks on the private banking side. But by and large, I mean, I can't tell you the last time in the previous decade where adjustable rate loans have actually been more competitive than a 30-year fixed rate loan. When you look at something that is fixed, you can go down to 15 and you will save some money on an interest rate. Rough guideline on it is somewhere between 1/4 and 3/4% more on interest rate to go to a 15-year loan rather than a 30. You can do 16, you can do an 18-year loan, 20, 25, whatever you want, but really the interest rate breaks on 15. And so when I have clients that are looking for a shorter loan term, one of the things I'll tell them is that you can do the 15 loan, you can save some money on the interest rate there, but the majority of the savings doesn't actually come from the lower interest rate, it comes from the lower loan term. So if you took 2 loans, one at a 30-year, one at a 30, exact same loan amount, and you have the 15-year loan at 6% rate, and the 30-year loan at 3. So short one is higher, long one is lower. You pay almost an identical amount of interest over those loans. So if you take a 30-year loan and just pay it off in 15 years, you're going to save hundreds of thousands of dollars on interest. If you just looked at the difference in interest rate, you're going to save maybe 10 to 20, maybe $30,000 over the life. So most of the time, I tell clients on that situation, it doesn't hurt to go with the 30 because then it gives you the payment flexibility. And if you want to pay it off in 15, you can do that. That's where you're going to save most of your interest. And the little bit of extra that you're paying on your interest rate is basically buying you the opportunity of having lower payments when you need it. Because if anything, the last 5 years have taught us that you don't really know what the future's going to hold. So make sure that you're in a position as strong as possible. Maximize your cash flow. You always have the option of putting that money into the mortgage, but it's really tough to lower your payments or get money out after the fact. How many people, hope not a whole lot of people, got in a situation where they refinanced into 15-year loans or consolidated a bunch of debt several years ago, thinking, oh, I'll refinance out of it in a couple of years. Rates go up and now it's screwed because they don't have that option. That's a situation that we're really trying to avoid for people. Say, put them in the most conservative option possible now. And if the market gets better, great. If it gets worse, I know that they are not in a situation hoping that something is going to change for the better. So that's really the big thing for me right now. This is why I don't really love temporary buy downs. For the sake of saying, oh, get into it now with a lower mortgage. $500 less right now because there's a guaranteed adjustment at the end of the year. You're going to be paying an extra $250 at the end of this year, and then an extra $250 after that. It's basically an adjustable mortgage. and you're hoping that your situation gets better. Nobody likes to get that notice at the end of the year that even your payments went up in taxes. And if your payment's going up $50 or $100 in taxes, imagine that on top of an extra $250, $350, $450 a month after this temporary buy down, that you've gotten used to your payment for a year. And if these clients aren't putting extra money away in anticipation for that, they're hoping their situation is better, that's not a good look. And it can really hurt relationships. So I only do that when people are very, very aware that if you have clients in that situation, make sure you set a reminder for 9-10 months out. Hey, just want to make sure that you know your payments are going to start adjusting here pretty soon. Have you prepared for that? Make sure that you're ready, expected. Because the last thing that you want is to get a notice in the mail, they forgot about it. And they're calling the lender going, why are my payments going up $400 a month?
Right.
You told me you wanted that. At the end of the day, it all comes down to the expectations. And any surprises, whether they were expected upfront or not, are never good.
Question about, I've got a mortgage. The Aunt Martha dies and leaves me $50,000. I want to apply that to my principal and have my lender recast my loan. Doable?
Yes. So that is a great option for another mortgage factor I want to touch on, which is, I'll tie these two in together. How to be able to buy without a contingency. Because right now, if you've got a home, low interest rate, obviously you want to hold that as long as possible. But if you're buying a new home, market's starting to be competitive again. So is there a way to buy without a contingency? There are a lot of ways. So if you've got your current home paid off for clear, you're going to use that equity to buy another property maybe outright, or just have a very, very small amount of finance. There are a number of things that you can do. One of them is getting a home equity line of credit on your current property and being able to use that for a down payment. And if you can have enough income to qualify for both properties, in the meantime, great, no contingency. Sell your current home after the fact. And then this goes into, okay, well now, rather than financing 200, I'm financing 600 because I haven't built my home yet. Once it sells, I'll have an extra 400,000. When that happens, you have two options. The first is you can apply that money to your principal with nothing special to it. Your payments won't change. What will happen is your payments, rather than paying this much in interest, will be paying this much in interest, and your 30-year loan turns into about a 3.5-year loan. If you want your payments to go down, you can do the recast. And a recast is something that almost all loans allow you to do. And to say, if you apply a big chunk towards principal, you can lower your payments down to the new principal balance. You'll still pay it off in 30 years, so it doesn't speed it up, but it gives you that lower payment. So this is a really good option for people who are buying without a contingency, planning to sell their home in a few months. Because at that point, as long as they can qualify and afford a higher payment for a few months, and they understand what that looks like, there are some risks on it. Then apply the payment over, do the recast. Typically, it's a one-time fee of a few $100, maybe $300-400. But they keep their interest rate. It's not a refinance. They don't have a new set of closing costs. It's a really, really good option for people in that scenario.
And they don't have to re-qualify.
Nope.
Yeah.
Nope. Maybe it takes a month or so. They'll have a couple forms, paperwork, and they just record the recast on it. But yeah, that's a really, really good option. So for people who are looking at selling and then buying, knowing that that option is available can really help lessen some anxiety about, well, we don't want to get a mortgage that's $4,000, knowing that we're going to later only need it for $1,200 a month.
Right.
Hold off for a little bit, and especially if they can pull out a little extra money, have it set aside. I mean, 10 grand in the bank can go a long way to lessening some anxiety about making payments. Whereas if they put an extra $10,000 for a down payment, that only saves about $70 a month. And I'd say that rule of thumb is a really good one when you're talking with buyers about as well. $10,000 in price or $10,000 in down payment changes your payments about $70 a month. Would you prefer to have $70 a month more or $10,000 in your pocket? For most people, it's $10,000 in your pocket. Because I don't care if my payment's $70 a month more. I can pull from this stack of cash I got over here and feel a lot better about it, especially if it's temporary. So I'd say doing that, having some money set aside, really great tricks to be able to help people transition over without that contingency and feel really solid about it.
Any other mortgage hacks we should know about?
A lot of them really come down to the individual situation. So the questions that I will ask people, and a lot of these, you might be batting 100 of these, 10% of the time, 5% of the time, these might come up. But in those, they're really good options to have available. And those are, is there a cosign? Do you have enough equity in your current home that you can pull out a home equity line of credit and use that as a down payment? Do you have enough money in your current home that you can pull out enough and pay cash for the new property? Now, not only do you have no contingency, but you pay cash for it. Then when your home sells, you're paying off that mortgage and either buying in cash or the remaining amount. And you can do a cash out refinance or be locked and pull the remaining from that. The debt consolidation purchase we talked about. Are there other debts that you can pay down to be able to qualify, to be able to get your things where you want them?
And while we're talking about debt consolidation, let's talk a little bit about the
Yes.
and sellers paying off buyers, buyers' debts.
Yep.
So that they qualify.
Yeah, so with all loan types, one of the options you have is to pay off personal debts to qualify, but you don't have to do it before closing. If somebody has, let's say, a car loan that's $500 a month, but there's only $5 grand left on it. That's a pretty big bang for your buck. But rather, if they paid it off now, then it's probably going to hurt their credit score. They're going to have to document where the money came from, that the loan is paid off, getting all this extra documentation on, thinking a bit of a hassle, and lowering their credit score can be some risks there. What lenders can do is on the application, they can say, oh, this debt will be paid off at closing. Then all we have to do is show that they have that $5,000 document that is in their bank account, they have enough money for their down payment, for whatever closing costs they need. And then we get a copy of the payoff statement for that car loan. At closing, when they bring in their check for their down payment, they also include extra money for their car payoff. This would be the same as like on the seller side closing statement. If you're paying off a contractor, it comes out of that closing statement. You could do this on the buyer side as well. So the settlement statement from escrow will say $5,000 going to Northwest Federal Credit Union to pay off this auto loan. And because that check is going out at closing, the lender allows us to be able to ignore that payment because we know it's going to be paid off. We're sending the check. So that's a really easy way that I'll talk with clients that says, okay, you're doing FHA, 3.5% down minimum. If you have the ability to do 7% down, let's maybe look at that money, pay off a car loan, and get you qualified for more than if you were to use that for a higher down payment. And I've got some clients right now, that's the difference between about a 310 purchase price and a 360 purchase price. And that's a very different price range. Because 310, I mean, there's not a whole lot there. 360, you actually have some options. And the difference for them is $4,000 in credit cards. They're paying off $4,000 in credit cards at closing and getting $50,000 in cash. So that's a big question I didn't. On the VA side, I didn't forget your question. VA is the only loan program that allows you to use seller credit to pay off personal debts at closing to help you qualify. So this can go towards car loans, credit cards, judgments. This can go toward anything that's being paid off.
And how do you, or do you have to specify in the paperwork that it's being used to pay off personal debt?
Historically, I haven't, but there's always an underwriter who might get a little picky with it. And they might want to say something like seller credit to be used towards buyer's closing costs, prepaids, rate buy down, and personal debt payoff. I haven't had to do that before, but it's not to say I won't have to do it in the future. So it's a good one to keep in mind there. It might come up.
And you still have to fall under that
The 4%. Exactly. So that could be one where same thing, rather than doing a rate buy down, maybe it makes more sense to pay out a car loan instead. The thing you want to keep track of, and this is, I guess, the thing that lenders will keep track of, and if you're talking to buyers about this, it can't be used to pay down debt. It has to be used to pay off debt. So if you've got $4,000 in extra credit, you've got a $5,000 car loan, it won't work. So if you have the creative ways you can do this, or if you've got somebody with no personal debt, you have extra seller credit, say you have an extra $1,000, tell them, hey, you got a Best Buy card, why don't you go down, buy yourself a new TV or something, and we'll just pay it off at closing with the extra credit. Totally doable. The only time we tell.
That scares me a little bit.
Yeah,
That scares me a little bit. I don't know if I do that.
I can buy a TV, I can buy a car.
Yeah.
So with the credit card they already have, don't open a new one.
Yeah.
So there are some creative ways there for sure to use that. I've also had to get a few buyers out of the things where judgment came up last minute. And it's, $800 judgment, they didn't have the money to pay it off. So we asked for more seller credit from the buyers, from the sellers, to be able to pay it off and close the deal.
And I have taxes.
Because back taxes would have to be paid off before closing, or if it's a judgment on the preliminary title report, it can be used to pay it off. Yeah. So pretty cool stuff.
I got a scenario.
Yeah.
So me and my wife own this home. We're stuck at 2.8% interest. We don't want to sell it. We want to buy another, we're getting old. We don't want any more stairs. We want a single level home. I have about $200,000 in equity in the house. My payment's $1,500 a month. I know it'll rent for like $3,000 a month. If I go buy a new house, I have 20 grand in the bank. I go take that 20 grand and go buy a new house. Are you gonna use the income from my home I have now minus the proposed income minus my payment as income for the next house?
We would use it to offset your mortgage payment.
Mhm.
Depending on the lender and loan product, it might not count the extra as income, but it will at least count it to offset your current mortgage payment.
Is that the extra rent coming in would not go towards my income?
Correct.
That's a bummer.
If there was a history of rental income on it in the taxes, we usually be able to count that. But if it's the proposed at this point, most mortgage lenders will only be able to offset your mortgage payment and not count the extra. So the rough rule of thumb is that if it's not a history of it on the tax returns, they're going to use 75% of the proposed rent. So if in that scenario, you could rent it out for $3,000, you get a copy of that rental contract for $3,000 a month, great, take off 25%, which is
Something.
$750.
Mhm.
So then the remainder, $2,250, could be used to offset your mortgage.
That's-
Since your mortgage payment's only $1,500, you would have some extra. That extra would basically, wouldn't really count as income for its next one, but you wouldn't be qualifying with two mortgages, you just be qualifying with one. That answer your question?
It does. I wish the income would count as income, but
Extra,
After the first year of rental history though,
well, that's not gonna, I guess it wouldn't really affect the overall picture because I'm, qualify for a certain amount, 600 grand. I'm sure I'd qualify for what I want anyway, but.
yeah, the difference would make $750.
But it would waive the six, so I'm going from a 2.8 to a 6.5. That's what's killing me. So my $4,000 a month, my $1,500 a month payment becomes a $4,000 a month payment.
Yep.
And so with the additional $1,500 from the rental, I would, it'd be a $2,500 payment. So it wouldn't be nearly as painful.
That's where, to me, it's what you qualify versus what you can afford.
Hmm.
On paper, yeah, the qualify doesn't count for the extra, but what you can afford it does. And so exactly the way we put that. If you could count the extra income, it would make a difference of about $50,000 as far as price range goes. So.
I'm so rich it doesn't matter.
Go over here. Well, I got that in my.
Yeah, no, I don't.
go back to that Civic Ferrari.
Well, I might next year. My son's graduating from U of O this Tuesday, so I might be richer next year.
Yeah. Extra mortgage payment right there.
That's right.
Yeah. So yeah, that's really the individual situation. Going back, there's is there a co-signer or the debt that they can pay off? Can they get a gift from family? Is there a loan that they can, personal loan they can give to them? I've got another client talked to me yesterday that they have family willing to give them $100,000 loan at 4% rate. Take it all. Can they give you 200? Yeah, take as much as you can get. And you can use that for down payment. They can use, if they want to record it, if they want to treat it as a gift, whatever the case is for them. But I'll ask those questions. What are the resources you have available for your situation? How can you apply that here to help you get where you want?
Anything else we need to know? So much covering now.
There's a lot of places we can, but I'd say a couple overarching principles or philosophies. you want to know enough to be dangerous, but don't be dangerous. So when looking at giving information to your clients about some of the things we're talking about today, it can be tempting to talk through some of the details for them. When I'd say in reality, what you want to be able to do is take this information and whet their appetite. Say, you know what? There's some pretty cool programs I heard a lender talking about recently that if you're selling the property and buying, might be a way to do it without a contingency that I think would really work for your scenario. Let me connect you with my lender, talk through the details of it because I don't want to miss anything up, but I think there's something here. Because that gets them interested, it gets them curious, and that's going to help give them motivation to keep moving. And this is really what we want to use is prevent discouragement, prevent a lack of motivation. But if you start getting into details, that's when now you might be liable for some information or heaven forbid tell them something that doesn't apply, and now you raise up their hopes. And I have to come in and say, hey, that's not the case. Honestly, that can really burn people out.
If you're working with a buyer, an agent is working with a buyer, and the buyer has a pre-approval letter from another lender.
Mistake one. Sorry.
Yeah, absolutely. And in your conversations with them, it becomes apparent that there are other options for them that they may not have explored with that lender. And you suggest, I'd like to give you to another lender. Their response is always, I worked with this guy in the past, he's great, I trust him, I'm gonna stick with this guy. What's the best dialogue for convincing them to just talk to them?
You're setting me up for a nice softball on this one. Because it is a valid, it's a really good question. Because we never want to try and steer somebody into a situation and force them into something. Yes, making people aware of their options and setting realistic expectations. The lender is always their choice. We have more information about why their choice may not be a good one. So figure out how you influence that. The best thing that I can say is that when buyers are shopping for a lender, most people think that that just means interest rates. They don't know what else they should be shopping. So the best thing that we can do is educate them on what that really means to shop. Because we all know the number one thing that you should look for in a lender is pre-communication. It's not a surprise. Every single person I've ever talked to in the street my career, and I said, what do you want to see in a lender? Pre-communication.
Well, and that seems to be like one of the, when you start seeing something where like, hey, your lender's not really communicating or not doing, you say, you might want to, here's Jordan, he just to get another opinion, just to find out what, where you're really at. And then we really did this, and within 5 minutes, and this woman's been working with this guy for months, and she lost the home and everything because the lender was not communicating and didn't do what he was supposed to do.
I use the verbiage like when someone brings me a rocket mortgage pre-approval letter, I'll say, listen, they're fine, but when I present that to the seller's agent, they're gonna question that. So let's get a backup and, just talk to Jordan or someone else someone local that everyone around here knows and trusts and.
So one of the best ways I found to actually get people excited about doing that rather than creating an obligation towards it is to let people know rate is important, but communication is more important. And here's why. You're going to have a lot of questions along this process. And a lot of the time you won't know what those questions should be until you get under contract. And that's the worst possible time to switch or realize that you made a mistake on the communication. Because the communication is not going to get better once you get into contract. If anything, it's going to get worse. So if you're not happy with the communication now, we need to switch. And so I've got a list of questions I can set out that's for clients. Like, this is the information you should be able to get and have from your lender. This is telling them, here's what you should be shopping for, information. And if you were shopping around for information and you're not getting what you're looking for, keep shopping. So that way they say, oh, I've got a lender that I've worked with before. They've done a great job on it. They're going to, I really like this guy. He puts a lot of smileys in his emails. Like, it'll be fine. It'll be fine. Well, ask him, some of the questions I got. Important questions to ask your loan officer. What types of loan programs do I qualify for? What programs do you recommend are best for me and why? What is the minimum down? What are my closing costs? How much is my maximum approval amount? What purchase price keeps my monthly payments at my ideal payment budget? Can I lock in my rate before I get under contract? Who's responsible for locking in my rate? And when is it time? Do you charge the appraisal upfront, or will it be included in my closing costs? What are my options for buying down my rate? Do you anticipate needing any other documents from me, or do you have everything that you need? How many purchases for my loan type have you closed in the last year?
That's a big one.
Will I be working with you directly throughout the whole process? Are you available evenings and weekends if needed? What is your process for sending out report letters? Like, those are the things that fortunately most people don't find out the answers to until they get a negative answer. And it's usually too late. When they can go through and get answers to all of these questions from their lender, if they feel they've got all the answers and they feel good about the answers, great. If not, I'd say ask all of these. And if you don't get all the answers and if you don't feel good about any of them, we need to have a conversation, because this is more important than the rate. So that's where very, very rarely are they going to get through that list and have any other response than, wow, I feel even better. Or who's the person you recommended again? Let me have a conversation with them, because I didn't feel good about it.
And if you're the agent and you're dealing with your buyer's lender, and you don't have that communication with them, they're not responding to your email, your phone call, all of that. What's the best way for an agent to maneuver around that
Well under contract or before?
while under contract?
I would bring in the buyers as soon as possible. And you want to be careful about it and not throwing anyone under the bus, because while you're under contract, everybody's part of the team, right? So it's, hey, just want to let you know, I've reached out to your lender, trying to get some information. Haven't heard back yet, but if you want to go ahead and reach out as well, let them know. See if you hear anything back first, that'd be great. It is a little time sensitive, so I just want to keep you in the loop. Because now you're doing a service, you're keeping your buyers in the loop, you're keeping them updated of what's going on. You're not saying this lender is not getting back to me, right? And the sooner you can do it, if you know there's a problem, the better. If you wait 3, 4, 5 days without a response and then tell your buyer, now you're waiting even longer for a potential response. So I'd say maybe 24 hours. If you don't have a response back in 24 hours, hey, Mr. and Mrs. Smith, just want to let you know, I reached out to your loan officer yesterday for some information. If you happen to hear back from them, touch base with them, great. Just want to keep you in the loop. Because then, if it needs to escalate, everybody's aware. It's not a surprise. It's not like, yeah, I haven't been able to hear from your loan officer in 2 weeks. 2 weeks. I didn't know about that. I've been talking with him every Thursday at Nickel. So preventative, setting yourself up to make sure success there. And if you're still not getting anything back, you're the quarterback in the situation. It's really your responsibility, even if it shouldn't be, to get things to closing. And so if you're not getting responses from the lender, go to the manager. It's their responsibility, their primary responsibility to communicate, to give you answers, to let you know what's going on. If you're not doing that, somebody else in that company is incentivized to help it happen, typically a manager. And if you're still not getting any information back on this, like, I don't know, situation called on there, does that, I think, for a while. That's when you need to start having some really firm conversation with the buyer and potentially the listing at that situation, because if you don't know what's going on, you're not getting the information that you need, you're under contract, deadlines are coming. The worst thing you can do is wait, hoping it will get better. Because again, it's rarely going to get better.
We had a situation where the lender, we were under contract and we were about 2 weeks in, and the lender passed away. Nobody let us know that. And so, the listing agent was calling, asking what's happening, have the appraisal in order, and where are we, and we're all sitting around. I left messages, I don't know.
I had a lender change companies in the middle of a transaction, didn't tell me.
Yeah.
He's no longer a lender for me.
Yeah, I mean, those kinds of things come up, and thankfully not often, but they do happen, and it becomes a real
An issue.
wrangle to get information.
Communication, it's the more that we can stress the importance of that to our buyers, what we already understand, and the more that they can get them to understand you are shopping for information, you're not shopping for rates. If you've got two people with great information, great communication, great, ask them what the rates are of that. But the more they understand on the front, the easier it will be to have those conversations later if it's a problem.
How do you approach like a property that maybe will have difficulty getting a loan? That you get like in the list, something that like has a 60 mobile home on it.
Gotcha. So the question is, how would you approach that? with others?
For a seller, if you're gonna be listing, I mean, what do you?
Well, the communication is, you just, it's probably not financeable as is. So it's going to be a cash,
So just a cash only,
cash only.
because I know there's occasionally,
There's our
like,
position to finance it.
there's some, like, when things are limited that way, there are some lenders that you could go to that will,
Oh, private one.
Yeah.
they weren't even, there was.
There are some lenders who will do those like older mobile homes in that situation. The down payments are gonna be higher, the returns are gonna be worse on it. So it might be one where you tell people, you need to tell your seller as well, it's cash or very, very few buyers can finance it. So it just shrinks the buyer's pool. And so what does that mean? Typically, fewer buyers, longer exposure time, and maybe impact on sale price. Because the more buyers you've got, the higher competition there is.
I wouldn't say maybe impacting sales price, it's going to it, because what's the fix for everything, it's the price.
Yeah,
I'm careful to do my job, not yours.
Yeah, those kinds of things, that's a hard conversation to have with a seller, because they don't know what they don't know.
yeah,
And so it's your job to sort of educate them, just what Jordan said.
well, they're kind of looking at it as like, do you sell, I mean, do you try to sell the property as just a land value? Is really the house, really, there's no. And so you don't even have that as part of the.
I think Melinda just recently had a situation in it closed, where it had an older manufactured home on it, perfectly maintained, well maintained. But very few people could qualify for that. The other issue with manufactured homes is manufactured homes that have been moved twice.
Yeah.
Your availability of lenders that will know on that is like. Yeah. Manufactured homes are troublesome for a number of reasons. Yes.
And last thing I would say, and this is just good practical advice in general, is when talking with clients, whether it's buyers, whether it's sellers, now more than ever, especially as you talk about the market the way that it is, there's a lot of anxiety, there's a lot of fear, there's hesitancy, is listening for what's important. Anytime that I'm talking with a client and asking, the analogy I'll use is that I'm a GPS. When I know what your destination is, and I know where your current location is, then I can help give you some options to get from A to B. Without knowing those, you've got 1,000 different options. I mean, can you imagine going into Google Maps and having 1,000 route options? It's not.
You just see your app.
Yeah. So for me, the destination is what kind of property are you looking for, what kind of price range, what kind of monthly. And then the current location is what's your credit score, what's your down payment, what's your income, what are your debts, the own properties. The less clear they are on those two things, especially where they want to go, that's where I focus my time on it. Because if they don't know what's important, they're going to have very wide search. They're going to decide every property case by case, as opposed to trying to find one property that fits a very narrow window. So my first goal isn't to say, let's get you pre-approved. It's to say, what is it that you really want, and help them find that. Then once they found it, the important things are listening for, are you payment sensitive? Are you looking to get a deal? Are you looking for a low down payment? Are you looking for low cash out of pocket? Are you looking for maximum cash flow, like multi-family versus single family? Are you looking for low maintenance? All of those things I'm trying to listen for, because if somebody says that they're very payment sensitive, well, then immediately I start thinking about, can we pay down their personal debts? Can we do an interest rate buyout? Can we put more money into down payments? And what are the things we can do to help that? If they are sensitive about cash on the pocket, then I'm looking at, can we do smaller down? Are they okay with payments being a little higher and not buying down everything? So that's all going to be geared towards giving them what they want, for whatever's important to them, different for everybody. So I'm always listening for what goes on, quickest timeframe, the most competitive offer, whatever those situations are. Everyone's different, and as soon as I know what's important to them, I can cater to that and help them get that.
I think that's true for agents as well. Once you know what's important to your client, you're better able to serve them. Huge thanks, Jordan, as always. You brought your A game.
My pleasure. Always appreciate it.
Thank you, guys. Thank you all for coming. And Brian, thank you for being on Zoom. If we have any other Zoomers, thank you. Gonna unzoom us. Oh, we did have other Zoomers. We had several other Zoomers.
And if anybody wants that list of questions I talked about, just let me know. You have my email, reach out to me and I can send that out to you as well through the client stuff.
Yeah,